All right, let's get started then. Okay, so it's December 18 meeting of the Financial Audit Advisory Committee to hear from our auditors, CLA, and from the committee, we've got myself, Julia Maliki, city councilors, John Oliver, and that's it at the moment. And other members are Alex Jablon and Carl Valenti. Oh, and JP, how do I say your name? Namayas? Namayas? I need his audio. I can.
Yeah, Namayas.
Namayas, thank you. Okay, I should have remembered it from the Finance Committee meeting. And
So the bummer was right there. Like we could see him laughing at Julia. We just couldn't hear him.
well, I grew up with the name Maliki that every nun at St. Bernard's had to learn, and now we have Rick Lipoff from the City Council, Steve Curley, our comptroller, and Stella Zaloshna, deputy, and from CLA Jim Petrowski, and I see Zach Fentros, and from the let me get it wrong. The comptroller's office as well.
Zach is actually representing CLA today as well.
Oh, he's CLA. Okay, I think he was at the last meeting in October, was it?
Yes.
Yeah. Okay. I'm sorry. That was the one I was doing from Michigan. Okay. Did I get everybody? All right. Thank you. So, Jim, you can get started.
Sure thing. Well, thank you, Julia. I'm going to go ahead and share my screen here.
Great.
With the deck, and can you see the screen that says City of Newton, Massachusetts?
Yes.
Okay, I'll go ahead and get started. So thank you for having us here today. This is really to provide our exit meeting update as far as the draft deliverables that we've distributed, which covers the draft comprehensive annual financial report, as well as a draft management letter for the June 30th, 2024 financial audit. So to go through, I will give an overall summary of the expected results. We haven't issued finals yet because the project's in QC, but we have provided the draft deliverables. So we'll talk about what the opinions are expected. Then Zach is going to get into some of the financial highlights for this year, talk about some of the significant footnote disclosures and figures there. We'll also cover the draft management letter as far as the comments that we identified through our special projects and otherwise. And then we'll tee up as far as the next meeting, what that looks like as far as going through the rest of the projects that we need to complete for this year. So to start with the opinions, we expect to issue unmodified opinions on each of the city's opinion units included in the annual comprehensive financial report. So it's the best opinion available. And this essentially means that, in our opinion, the financial statements are expected to be fairly stated in accordance with generally accepted accounting principles. Through these processes, we do have to evaluate the city's internal controls, and we will produce a report on internal control over financial reporting as well. We would anticipate that report would come out with the single audit report, which we'll discuss the timing of later on. But at this point, we don't have any internal control deficiencies to note that arose to the level of significant deficiency and material weakness. Now, we do have some standard practice recommendations in the management letter, which Jack is going to cover early on. But overall, as far as the financial statements are concerned, clean opinion, no significant findings to note with internal controls. So with that, I will go ahead and turn it over to Zach, who's going to cover the financial highlights for today.
Thanks, Jim. So first, we're going to get started with the government-wide financial statements. And so today we're going to be talking about a few balance sheets and a few income statements, and I wanted to provide some context about what are the government-wide financial statements. It's essentially the long-term financial view for the city of Newton. Essentially, when we're looking at your governmental activities, it's the city's general funds, stabilization funds, your special revenue funds, your capital project funds, and your trust funds are all consolidated together, presented in one column. And then the city's long-term assets and the city's long-term liabilities are included there. And what we wanted to focus on with our presentation today in regards to the governmental activities was your liabilities, which is primarily your liabilities are 1.2 billion, and they're primarily made up of some of those long-term liabilities. And that first long-term liability is your bonds payable, which approximately had a balance of about 300 million as of June 30, 2024. This figure is largely unchanged from the prior year. The city had $30 million in new issuance, which we'll get into a bit later in our presentation, as well as $30 million in principal payments on your existing outstanding debt. So that's why that figure, again, is largely unchanged from the prior year. You had new issuance of about 30 million. You also made principal payments of about 30 million. The next two, and the next one in particular, had a very large change from the prior year, and that's your net OPEB liability. And OPEB stands for other post-employment benefits. And it had a balance of approximately 455 million, which is about a $205 million decrease from the prior year. So this is a rather large decrease from the prior year. So essentially, the city hires an actuary to come in and perform an actuarial analysis to determine what that liability is. And the big change that led to this decrease was the change in the discount rate. In your prior year financial statements, the discount rate was 3.65%. And in this year's financial statements, that discount rate is 6.00%. So that discount rate increased again from 3.65 to 6%. And the reason for that increase in that discount rate was your actuary performed what I'll call a depletion analysis of your OPEB trust fund and was able to determine that that OPEB trust fund is not going to essentially run out of funds into the future. And because it's not going to run out of funds into the future, it allows the city to utilize a higher discount rate. If you were to be running out of funds, the accounting standards require that you use the municipal bond rate, and that municipal bond rate is around that 3.6%. But again, your actuary determined that OPEB trust fund, again, is not going to run out of funds, and we're able to utilize your investment rate of return, which was 6% as of June 30, 2024. So that's the real reason you see that big decrease in your net OPEB liability, is that big change in the discount rate. And that's the biggest change in your financial statements from 23 to 24 is this net OPEB liability from a long-term financial view for the city. Next is your net pension liability, and that had a liability of approximately 296 million. It's about a $15 million decrease from the prior year. Now, that decrease is primarily due to investment results of the pension trust fund coming in greater than what was anticipated, and it came in greater than what was anticipated by about $18 million. So again, you had positive investment results, but they were so positive that they came in about 18 million greater than what the city projected, which is why you see that decrease in that net pension liability of about $15 million for your governmental activities. Your net position for your governmental activities, you have net investment in capital assets of 409 million, restrictions of 92 million, and then your unrestricted is actually at a deficit of 923 million. But that deficit's primarily driven by your unfunded OPEB and pension liabilities. And that's not uncommon for what we see in the Commonwealth, to have a deficit unrestricted net position for your governmental activities. So I would not be concerned about that. It's, again, similar to what it was in the prior year. But again, nothing to be concerned about. John, I see you have your hand raised. Do you want to jump on in and ask a question?
Yeah, and it has to do with content on this page, but I don't know if you want to finish this section before you let me babble on.
Would it help to pause for questions at each slide? Is
Sure.
that okay?
That's fine with me.
Okay, good. Let's do that.
All right.
Go ahead, John.
So then I am curious, because in the past there have been conversations in the finance committee and the council in general as to the right ratio, I think is the right term, of bonds payable to, like, for a city of our size with the financials that we have. Is there like a rule of thumb that you all use, what kind of outstanding debt we should have in terms of bonds payable?
Jim, do you want to jump into that one? I've got a response, but I'm curious what your take is on that one.
Yeah, I think my initial response there, John, I think we're going to cover it later in the presentation, but mostly what we see from a debt service perspective, I would say it's actually more of a short-term focus, which would be your debt, your unassigned fund balance or your free cash compared to your annual debt service expenditures. So that's the ratio when the bond rating agencies are looking at it. They want to make sure that there's a sufficient amount of unassigned fund balance to cover your expenditures. So they'll look at that in relation to your total expenditures, and then your debt service in relation to your total expenditures as well. That's not, the government-wide statement that we're covering here is different because it's a long-term focus and it's reporting the total amount of debt, but it's that short-term focus, which we'll cover later on, that's going to be more scrutinized as far as that availability of fund balance to cover the annual debt service.
Right, but that's a little different, right? Which I think is what you're actually explaining. It's not total bonds outstanding or issued to the, the total picture of the financial, state of the city. It's the payments
You
compared
got it.
to our, right, to the operating. Okay. All
You
right,
got
so
it.
it's really not total amount of bonds out there, having been issued. It's the payments on them.
Right.
Okay.
Right.
All right. Okay. Thank you.
And I just had,
JP,
I just had a
sorry,
question.
Julia.
Oh, yeah, I just had a question regarding the change in the discount rate, and I feel like I've asked this before, but the being viewed as not going to run out of funds, is that a stable situation now? Or is there a risk that we would have to flip back and use um, the municipal bond rate instead of our actual results rate?
There's always the option to have to go back to, in some way, use a blended rate or just the straight up municipal bond rate. If, for example, the city were to make some changes to the benefit terms where you are now covering a greater percentage of those investments into the future, that would certainly impact the actuaries, analysis, and it may change to their depletion analysis now showing that you are going to run out of funds and that OPEB trust fund is not going to be what I'll call self-sustaining into the future. So there is a possibility that it could change. So I don't want to sit here and say it's never going to change, because some decisions could be made by the city to affect that analysis by the actuary.
It would basically be driven by a city decision as opposed to the general economy or the stock market or something like that.
If the stock market were to tank and your funds were to be depleted
Actually.
heavily, it certainly could change that analysis as well. So I can't say that the economy is not going to affect that. It certainly could if there was another large decrease in your market value of your investments. It certainly could have a big impact, and it could lead to that discount rate decreasing into the future based upon what your actuary is doing.
Okay, all right, let you move on.
And not to cut you off, Zach. JP, did you have a question? I saw your
Actually,
hand
that
up.
was I had the exact same question about the discount rate, like whether or not we could see it sort of stabilizing or not. But that was my question.
Okay. Thank you. Sorry, Zach.
No need to apologize, Jim. So the last thing on this slide is your business type activities. So your business type activities, we're going to talk about in more detail and further in the slides, but what makes up your business type activities is your water fund, your sewer fund, and your storm water fund. But again, we're going to talk about those individually further on in the presentation. So Jim, if you could go to the next page. So your statement of activities is essentially your income statement for your long-term financial view for your governmental activities. And you had an increase of net position of 116 million. And that's primarily due to those decreases in that OPEB and pension liabilities that we talked about on the prior page. You had total expenses of 531 million. And the largest piece of that is your education expense, which makes up about 61% of your total expenses. So your total revenues and transfers are 647 million. And then you have program income of about 161 million. And then your state aids, gifts, and education are at 92 million. And then your general fund, or your general revenues and transfers are at 486 million. And the largest chunk of that is your real estate at 426 million. I see a couple more hands raised. So I'm done with this slide. So JP, I see your hand raised first. Go ahead.
And this is purely, maybe you can't answer it and maybe somebody else can, but what has been the trend sort of the expenses and the revenues specifically for this governmental activities over the past sort of 12 months or so? And I apologize, I'm totally new and I haven't audited all of the financial statements of the city, so
Sure.
But if somebody has,
can,
that would be great.
From a governmental activity standpoint, they can tend to, especially on the expense side, they can change from year to year based upon the impacts of that pension and OPEB liability, because they will either be shown as an increase or a decrease in those expenses year over year.
And I understand that part. I'm asking in general, like, has the trend been trending up? Has this been sort of stable in terms of the amount of money that's being spent?
It's maybe tougher to talk about it from a governmental activity standpoint. I think, JP, that question would be better served on a short-term financial view for the city rather than the long-term financial view for the city. Okay. So I think that maybe that question would be better posed in when we talk about the more short-term financial view of the city.
Cool. All right.
Right, and just to elaborate a little more on that, Zach. So JP, generally, what you expect, your largest fund is going to be the city's general fund, and essentially that's going to increase with the growth in the tax rate, right? So generally, it's always going to trend upwards. We would expect, just because if the tax rate continues to increase, expenses and salaries continue to increase. Generally, these are going to increase. It is more difficult with the government wide because you have large gap balances that require estimates, methods, and assumptions that are going to change those expenses year to year. So that's why it's a little tougher to project. But generally, when we talk about the fund financial statements, they would trend upward, specifically in your general fund.
Okay. Julia?
Oh, I'm sorry, that was left over.
Okay. So Jim, we can move on to the next page. So this is your governmental fund. So what I was talking about prior was the long-term financial view for the city. When we get into your governmental funds, this is the short-term financial view of the city, and that balance sheet can be seen on page 18. And essentially, there are going to be 7 columns on this page. You're going to have your general fund, and that's going to be your general fund plus your stabilization fund. Then you have 4 major funds. Your CPA fund's a major fund, your ARPA fund's a major fund, and then you have 2 construction or capital project funds that are major this year, which are your Lincoln Elliott Construction, as well as your new Center for Living Construction. And then you have what's basically your remaining, which is considered your non-major governmental funds, which is your other capital project funds, your special revenue funds, and then your trust funds. They're all consolidated together, presented as non-major on that page. But for our purposes today, we want to focus just on the general fund due to its importance to the city. So from a fund balance perspective, the city had fund balance of 128 million, again, as of June 30, 2022. So the breakdown of that 128 million is 2 million was for restricted, which is your debt service as well as your capital stabilization. And this is largely unchanged from the prior year. Your committed fund balance did have a large change from the prior year, and it is at 48 million. So this is comprised of your continuing appropriations, your free cash that you've set aside to be used in your FY25 budget, and then your education and capital stabilization funds. And that education stabilization fund is the big change from FY23 to FY24. This is a new stabilization fund that was created during fiscal year 24, and it was about $22 million that was put into that fund. So that's a very large increase in change from the prior year. If you looked at your committed fund balance from the prior year, you would expect to see it about $22 million or so less than what it is at the current year. For your assigned fund balance, this is made up of your encumbrances, that unused expenses that are going to be carried forward into FY25, as well as your capital. And again, this is largely unchanged from the prior year, an assigned fund balance of about 13 million. Now, your unassigned fund balance, in my opinion, is the most important figure in your financial statements. This is what essentially is the starting point for your free cash calculation. So users of the financial statements, such as a bond rating agency, place a lot of emphasis on this unassigned fund balance. And what makes up that unassigned fund balance is your rainy day, your stabilization funds make up about $26 million of that. And then the general fund is the delta of that. So what this represents is 11.3% of the total revenues and other financing sources from page 9. What the Government Finance Officers Association recommends is about 17%. So you're a little bit less than where the GFOA or the Government Finance Officer Association recommends, but by no means is that a bad financial position for the city to be in. So last year, that ratio was at 15.1%, and it decreased to 11.3% in the current year. Now, that decrease is due to the creation of that Education Stabilization Fund. The city took $22 million out of stabilization and put it into that education stabilization. So the funds essentially just went from unassigned fund balance and moved it up to committed fund balance in the current year. So that's why you see that decrease in that ratio from 15.1% to 11.3%. And that was all I wanted to say on this page. And I see, Alex, that you have your hand raised with a question.
Yeah. So you just talked about like the ideal ratio on the unassigned amount. What about the other categories of the general fund, like, you know, the restricted, committed, etc.? Were those in line with what you would kind of expect?
Yes, largely they don't really change that much from year unless there's a large a new, you know, stabilization fund like there was for the city this year. There's no necessarily like ratio that I've seen from you know, your bond rating agencies or others that they look at in relation to those. Jim, I don't know if you've seen something where they like to see unassigned, or excuse me, assigned or committed or restricted at a certain balance?
I would agree with that generally, Zach, is that unassigned is going to be the key figure to determine as far as is evaluating the financial health. One that I believe MD&A discusses is the total fund balance of the general fund. But as far as those other specific categories, Alex, I haven't seen those given too much focus as far as an ideal ratio there of what those other categories, restricted, committed, assigned, should be.
Good to know. Thank you.
Julia?
Yeah, my question might be similar. So, does the fact that we, in creating the Educational Stabilization Fund, we basically kind of labeled a certain amount of reserve for a certain purpose, which makes sense given that 60+% of our budget is schools. Does that kind of counteract the negative effect of having a 11.3% ratio instead of being closer to the recommended when bond agencies and people are looking at us?
I'm not going to speak on behalf of the bond rating agency. When you do meet with them, I would make sure to really emphasize this fact that yes, we had a ratio of 15% last year, but we just specified, the unassigned fund. We specified and created a new stabilization fund to really emphasize that, so that they understand that. They may have a question, why did it decrease? So when you're speaking with the bond rating agency, because I'm sure a meeting will happen at some point here in the future, make sure that you're really emphasizing that, the decrease is due to us just moving this up 3 line items into a committed fund balance rather than an unassigned fund balance, so that they've got some perspective on that change.
Okay. I'm sure Maureen will do that. Okay, thank you.
Welcome. Jim, do you want to go to the next page, please? So your general fund statement of changes in fund balance, or your income statement for your general fund, it had a net change in fund balance of 11.9 million. Now, this increase in your fund balance is primarily due to positive results of operation from your budgetary results of operation. And your budgetary results of operation can be seen on page 22. So the city used prior year carry forwards, which is your encumbrances and your article carry forwards, of about $30 million. Additionally, used about 28 million in free cash. And then on the revenue side of the equation, you had turnbacks. So the revenues came in greater than what was anticipated by the city by about 26 million. And the largest for those was and investment income came in at about $11 million greater than what you anticipated. $5 million came in greater for real estate and personal property taxes. And then your licenses and permits came in about 3.7 million greater than what you anticipated. Similarly, on the expenditure side of your budget, expenses came in less than what you anticipated by 38 million. So in total, you essentially had turnbacks of about 64 million. So what it can be thought of is that the city beat the budget by about 64 million. And the largest pieces of those turnbacks on the expense side of the equation is 11 million for your streets and sidewalks, 5.9 million for your public buildings and maintenance operations, 3.5 million for education, and 3.6 million for your parks and recreation. Jim, if we could go on to the next page. This is where we're going to start talking about your enterprise funds. So, and previously we had talked about your business type activities that were made up of your sewer, water, and stormwater, and this is where we're going to talk about them as individuals. I'm not going to focus on the net OPEB and net pension liabilities for your sewer, water, and stormwater and talk about them, because the same trends that we saw on the governmental activities are going to be the same trends that we're going to see here in your enterprise fund. So for net OPEB as well as net pension, they did decrease for all three. So it's the same reasoning and the same explanation that we had previously talked about for why those liabilities decreased from 23 to 24. But what I will talk about is your bonds payable. So for your sewer fund, you had liabilities of about 25 million, and bonds payable makes up about 13 million of that. And that is a decrease of about 1.7 million from the prior year. And that decrease is due to the principal payments that the city made on their outstanding bonds. The city also had net position of 94 million, and that was broken down to the net investment in capital assets of 76 million, as well as your unrestricted of 19 million. The change in net position was actually a decrease of about 800,000. And that was primarily due, so last year was an increase of about 5.5 million. And that was in the prior year, that was primarily due to some MWRA grants that received in FY23 that the city did not receive in FY 24, which is why you see that change from FY23 to FY24. Jim, if you could go to the next page, please. Next, we have your water fund. And your bonds payable in the water fund were at 28 million, which is a decrease of about 1.2 million from the prior year. So the city did issue some new debt in relation to the water fund to the tune of about 2.1 million in new debt, but you also made principal payments of about 3.3 million on your outstanding debt in your water fund, which is why you see that decrease of about 1.2 million in fiscal year 24. Moving down at the bottom of the page, we have that change in net position of about $6 million. That is consistent. There you go, Jim. It's consistent with the prior year. And then we can move down to the stormwater fund. Stormwater fund had bonds payable of about 4 million, which is a decrease of about 400,000. Again, it's due to those principal payments on your outstanding debt. And it had a change in net position of about 1.2 million, which is again consistent with the prior year results of operation for the stormwater fund. Your internal service fund. So it's shown as a proprietary fund, but it's actually not included in your business type activities that we talked about earlier. That would actually be included in your governmental activities. And essentially, your internal service fund is your health and workers' compensation funds. And that had total liabilities of about 24 million as of June 30, 2024. So your IBNR, which stands for incurred but not reported, those health claims are about $7 million of liabilities. And then your workers' compensation liability is about $10 million, which leaves you with a net position of about 19 million. And the breakdown of that is 11 million for your health insurance and about 8 million for your workers' compensation. So again, that change in net position for your internal service funds in totality was about 5 million. And the city has a target of between 1.5 and 2 months of net position in relation to the average monthly claims. In the city, as of June 30, 2024, was at 1.7. So you're right in the middle of where the city would like to have the net position for the health insurance. Your internal service funds is exactly where the city would like to see it be. Moving on to the next page. So your fiduciary funds, and on your fiduciary funds can be seen on pages 27 and 28, but we're going to focus primarily just on the pension trust fund as well as the OPEB trust fund. And they're presented together and consolidated together on page 27 and 28, but they're actually broken out on page 77 and 78. So if we were to go to page 77, you would see that the pension trust fund has a net position of 531 million. And that net position primarily consists of cash and investments for that pension trust fund. And on the statement of fiduciary net assets, there was a change in net position of 57 million compared to a decrease in net position of the prior year, 53 million. And these really relate to the net investment results for the year. So you can see that right below that, there was net investment income of 51 million in the current year, which is why you see that change in net position of 57 million in the current year. But in the prior year, the city actually had an investment loss of 57 million, which is why you saw that loss in the prior year of 53 million. Generally, what I found is that the pension and OPEB funds really increase and decrease in conjunction with the market. So in years where there are positive returns, you will see an increase in your net position. In years where the market's having a down year, you generally will see a decrease in your net position for those funds. Jim, if we could go to the next page, which is your OPEB trust fund. And that had a net position of 38 million. And it had an increase in change in net position of 7 million. And that 7 million, so the city had contributions of 27 million. So the actual cash contributions to that fund were $4 million. And then there was gap accrual pay as you go of 23 million. So that 23 million is shown as both a revenue and an expense in your OPEB trust fund. It's just a gross up based upon a figure that we actually take right from your actuarial valuation. And then you had an investment income of 3.2 million. So you had cash contributions of 4 million and that investment income of 3.2 million, which is why you see that change in net position of an increase of $7 million from fiscal year 23 to fiscal year 24. So some significant note disclosures. I did touch on your long-term debt earlier, but that can be found on pages 57 through 65. And you have total outstanding debt of about 345 million. Again, the breakdown of that is your governmental funds at about 300 million, your water fund 28 million, your sewer fund 13 million, and your stormwater fund 4 million. The city did issue $32 million of new debt in the current year. Excuse me. 30 million of it was for your governmental activities, and then $2 million of it was for your water fund. Additionally, the city did do $12 million of refunding debt this year as well. Jim, if we could move on to, oh, go ahead, Jim.
Yeah, before we move on, just you'll find more information on page 60 about the refunding debt as far as the economic benefits of that issuance. There's some additional footnote disclosure on page 60.
For the OPEB, the note disclosures for the OPEB can be found on pages 66 through 70. And so the liability as of June 30, 24 was 466 million. In the prior year was 676 million. But again, we talked about the reason for that decrease, which was again, primarily your discount rate. One of the more important items in there is what I'll call the sensitivity analysis. And then there's two of them for your OPEB trust fund. And it shows basically what would the liability be if the discount rate was 1% higher or 1% lower. So your discount rate is for your OPEB is at 6%. So if that discount rate actually went to 5%, that liability would increase to 531 million. But if that discount rate was actually at 7%, it would decrease to about 412 million. Likewise, they also show one in comparison to the healthcare trend rate. And the healthcare trend rate as of 6/30/24 is 7.5%. So if that healthcare trend rate decreased to 6.5%, it would bring that liability down to about 402 million. And if that healthcare trend rate increased to 8.5%, it would actually increase the liability to 545 million. So some of these figures with the discount rate as well as the healthcare trend rate, they can really have a large impact on your liability and really swing it, quite significantly one way or another.
How much has that rate varied in the last few years? Is that sort of a published governmental type blessed rate, or is that something our actuary determines?
Are you asking about the discount rate or the healthcare trend rate?
The healthcare expense trend rate.
It's pretty consistent year over year. Jim, I don't know if you've got some more insight into that figure.
That's actuarially determined. They have to obtain information from the city to come up with those methods and assumptions. I think generally, as far as the trend rates that they've presented, they would be generally consistent with what we see with other communities and the health insurance in general. So I would say more so actuarially determined, but they do have to obtain inputs from the city as far as updating.
Okay, so it's the city's actual experience and
yes,
not
yes.
not a kind of a more global figure. Okay, thanks.
Moving on to pension, which is note 19 that can be found on pages 73 through 77. That the liability at it's actually June was really 12/31 is 304 million, excuse me, and it's a decrease in the prior year's balance of a liability of 321 million. And again, that decrease is primarily due to the positive investment performance that the retirement system experienced in calendar year 2023. And the sensitivity for the pension is currently at 6.9%. So if that discount rate were to decrease to 5.9%, it would increase that liability to 398 million. Likewise, if the discount rate were to increase to 7.9%, it would decrease that liability to 226 million. So that's the sensitivity analysis in relation to the discount rate for the pension fund. And that concludes everything we wanted to talk about from your annual comprehensive financial report. Are there any questions on the ACFR before we jump into the management letter? Perfect. So we did have, sorry, Julie, go ahead.
That's good.
Oh, Carl, do you have a question? Carl, you're on mute. Carl, you're on mute.
Sorry about that. Thanks, Zach. You mentioned for the health insurance fund that there was an 8.6 million audit adjustment. Could you speak a little bit more about that?
Carl, we're actually going to cover that in the management letter. So
Okay.
this, yeah, it's upcoming in an upcoming slide.
So the management letter. Again, as Jim stated, there's no material weaknesses or no significant deficiencies. So like in addition to us proving out the figures in your financial statements, we also again look at the internal controls of the city. And if we were to have any recommendations for the city to improve those internal controls to ensure that your assets are being appropriately safeguarded, we'd make those recommendations here. So we have just a few this year. The first one is a new one. So we performed what I'll call a walkthrough of the off-leash dog license program. And what we were able to identify is that there's no the off-leash dog licenses are tracked through City Hall systems, which is a separate software from the city's general ledger. But there's not a reconciliation to compare what was collected in as shown as revenue in City Hall systems compared to what's in the city's general ledger. So what we're recommending is that moving forward, there should be a reconciliation process between what was entered into City Hall systems and then what was entered into the city's general ledger to make sure that they agree. At times there can be mispostings or errors that are made. So having that reconciliation is really important to ensure that there are no errors on posting or classifications. Yes, Alex.
Yeah, so I did have a question on this one specifically about periodic reconciliation. I was just wondering, and this might just be a difference between external and internal, private and government, but why was this classified as a recommendation as opposed to a finding? If there's, account reconciliation is a pretty, key control. So I was just kind of wondering how that determination was made.
I would classify this as a finding, and our recommendation to resolve that finding is to perform those reconciliations. I think we may be just having a terminology issue.
Yeah, that sounds like.
I think I know where you're going with that, Alex, as far as why this was a management letter comment as opposed to a GAO significant deficiency material weakness. Key consideration here is materiality with this transaction class. The dog licenses, this is not a material activity. And when we had discussed our planning with the city, that this was an area to look into as far as, this was a program that hadn't been looked at by us in a few years, and we had dug back into it. So like these types of special projects, we had met to discuss these during our interim period. So this was a very specific narrow revenue source that wasn't material, but it was requested that we look at it. So in this case, and looking at the other controls in place regarding the posting, we feel that the mitigating controls, such as there's not a periodic reconciliation of fees in City Hall to Munis, but there are other reconciliations in place where you look at your daily deposit, you look at your monthly bank reconciliations. Those are all being performed appropriately. So we feel like the controls in place are sufficient enough that essentially these licenses are going to be fairly stated. To obtain that additional assurance over this transaction class, we would like to see periodic reconciliations so that if they're being posted to the license account in City Hall systems, they should be periodically reconciled with Munis. It may detect some more minor misstatements or mispostings, but generally the controls are sufficient to where your financials aren't going to be materially misstated. Does that help clarify?
Yes, absolutely. And just a quick follow on, did you guys run into that, anywhere else that there was just kind of like, disjointed systems in which, a reconciliation maybe would be beneficial?
This is a comment that in past special projects, we have provided recommendations on periodic reconciliations of systems. So essentially, you have an we'll call it a delegated system for City Hall systems with the dog licenses. You have a few of those in the city with some of the special projects that we look at. We'll typically want to see there's some sort of reconciliation of the revenue accounts in Munis that correlate to those revenue collections to the actual permit or license or other systems where those initial point of sale transactions are recorded. So it does happen usually when we've done a project like this reconciliation comment has popped up before.
Just
Okay,
maybe
perfect. Thank you very much.
Jumping ahead a little bit, Alex, but to kind of touch on your question, I did perform a very similar walkthrough of the Newton Community Education Program. And similar to Dog Leash, they have a system where they're tracking, outside, but they actually are performing those reconciliations between their system and Munis. So there wasn't a recommendation for the Newton Community Education Program because they aren't performing that reconciliation that we would recommend.
Okay, awesome. Thank you, guys.
It looks
Steve?
like because it's
I was just going to touch on a little bit, but I think Jim had mentioned it as his conversation went on. But we get a daily report from City Hall Systems of all the payments that are tied to what are called charge codes, and those charge codes correlate to org object combinations in the system. So we get a daily report of what was received. That's reconciled with the bank, and then we call it internally a cash receipt that gets deposited, and we reconcile that. And then Treasury reconciles their cash with our office's cash each month. I think the deficiency seems to be with more specific dog license information and trying to almost a one-to-one. I looked at some of the stuff that Jim had sent our clerk's office on trying to extract, and there seems to be some deficiencies in City Hall Systems on how we can kind of pull those out. And I know that they were looking at going into, is it OpenGov? Jim, is that
Yes.
what it's called?
Yep.
Looking to transfer over to that system in the coming year because of some of these. But we do it at a different level, but so there is a level of review there. It's just not exactly I don't know, foolproof.
right. And the periodic reconciliation piece on top of that, Steve, for that analytical review against the two systems is strengthen, on top of the daily reconciliation. If you had to strengthen controls around this program, a periodic reconciliation we'd recommend to be beneficial. Looks like Julia has her hand up.
Yeah, I was just curious. So, and this special project, I guess you were focusing on the off-leash licenses, which is kind of a subset of the dog licenses in general. People get one kind or the other kind. So is whatever happens or recommendations for dog licenses, that would apply to all licenses, not just the off-leash ones, I guess?
That would be a fair statement, Julia. The off leash is a much higher fee, so that's really the focus here. But generally, yes, it would apply to because those initial license fees are part of the total off leash fee. So yes, generally that would apply, Julia.
Yeah, it seems like it's one procedure, and it's just the price varies depending on what type you're getting. And
Yes.
and does, maybe this is for Steve Curley. The other types of licenses that the city clerk's office issues, marriage licenses, whatever, are they all part of the City Hall Systems? And
Yes, they
stay
are.
that way, or would that eventually go to Munis like everything else, or would that be kept separate for some reason?
So they're looking, those are marriage certificates, death certificates, some of those other birth certificates. Those are all on City Hall Systems, and I know they're looking to transfer everything that the clerk's office has on City Hall Systems over to the OpenGov. But it would be very similar to what we've discussed regarding off-leash dogs, where we have the money come in, it's set to go into a certain account. We see the daily totals, we match that up against the bank totals. And then it gets processed into the general ledger. It's kind of an after the fact, after that gets posted to reconcile it back to City Hall Systems, that becomes the difficult piece.
Okay, thank you.
You're welcome.
So moving on with the off-leash dog licenses, another thing that we notice is that there's not any periodic review of the non-renewal data extracted from City Hall Systems. So what we're recommending is that the city perform some analytical reviews, such as customers who purchased the license in the prior year, but not in the current year, our licenses with non-renewal dates greater than 60 days, and then a data relationships such as like the renewal date of the license in comparison to the expiration of vaccinations for their animals.
And Zach, I'll speak a little more since I was more in direct communication with the clerk's office. Essentially, what we expect from OpenGov and the conversations with them is that there's a good amount of data available behind these licenses to where they could develop some analytical relationships that may not make sense. The for example, the dates comparison. If there's a comparison of dates, they may identify licenses that are tracked in the system but granted to a customer that may not be appropriate because of vaccinations not on the animal. So just those types, just really, when OpenGov is implemented, seeing what type of sort of data analytical procedures are available to look at unusual relationships here is what we're focusing on. So, and that's more so when OpenGov is implemented in 2025.
And then the last item that we noticed that there's no reconciliation to compare the number of physical tags issued. So there are pre-number tags that the clerk's office has, and then comparison to those of the licenses that were issued in City Hall systems. So what we're recommending is a comparison of the number of pre-numbered tags that were issued compared to the number of licenses that were in City Hall systems to ensure that none have gone missing or that none have been given out without receipt of payment. And Carl, sorry, go ahead, Jim. Carl, this next recommendation for the financial close, I think is what you were referring to. If it's not, please let me know, Carl. So for the financial close and reporting, this is another new recommendation. And the first one is for the health insurance fund. What we were able to, in conjunction with Steve, we were able to identify that there was an error in posting of about $8.6 million between the employee and employer contributions to the health insurance fund. When we were doing some analytical work through our procedures, the numbers didn't kind of give us a warm and fuzzy feeling. So we reached out to Steve, and he did an analysis to be able to identify that when the city moved over to Blue Cross Blue Shield, there was an error in the spreadsheet used to provide that, to upload that information into Munis. It's since been corrected, but Steve did have to post an adjustment of that $8.6 million to reclassify those contributions out of employee contributions and post them to employer contributions. So what we're recommending is that the city consider doing some analytical trend analysis year over year to see if there's any anomalies or inconsistencies as part of the financial close process. Carl, is that what you were referring to?
Yes, Zach, thanks.
And then the next item that we had in relation to the financial close and reporting process is in relation to your capital assets. When we received the file from the city, we noticed that there were some errors in depreciation of capital assets within the database. The city is currently using an Excel file to track capital assets, which can be very time-consuming and cumbersome for the city. And it also can lead to human errors with a spreadsheet that large. So what we're recommending is that the city consider implementing an automated system for tracking capital assets that will calculate that depreciation automatically for the city, and it would just trim down on any possible errors as part of that process. Yes, John?
Thank you, sir. Just with regards to the the health fund, I'm curious, what are the implications for that? Does it have anything to do with how year-end tax statements are put out for the for employees, or I don't know. I'm just kind of curious if there's anything kind of downstream that this is going to impact.
From my perspective, I don't think so, but I'll turn it over to Jim and Steve to see if they've got any insight into that.
John, I would ask Steve to speak on year-end tax statements, and then as far as the overall implication, I can get into that if Steve, you want to elaborate on John's first question.
Sure. So I'll go over kind of the whole process and what led to this. We were on Tufts and Harvard for several years, and basically what happens is you have your gross pay, and that comes out of a salary line. The employee is responsible for whether it's 20, 25, 30% of the health payment. And then you have sorry, I got to pop up. And then you have the city portion, which is paid out of the fringe benefit lines called 57 Health. You would see those lines across the legal level of control during the budget process. Those are where those benefits lie. And so when the payroll is run, you're pulling we'll call it 20% out of the employee's gross pay, the 51 account, and then you're getting 80% out of the fringe benefit account. Those both drop into an agency liability account, which then we have to transfer that liability. And so now we have it broken out between, there's several buckets, whether you're the 80-20, the 75-25, the 70-30. There's very few people who are now on a 65-35, but those drop into those buckets, and both the employee and employer portion drop into the same bucket, the way the payroll functions. So then we built a template, which we extract those numbers monthly, drop it in the template creates a journal entry, and then we import that journal entry back into Munis to post it. It was solely a matter of, so we get the MTRS, which is the Mass Teachers Retirement benefit payment, and we get the Newton Retirement System benefit payment. It was, and Zach, you might remember, it was either the MTRS or the NRS in our Excel sheet. We had flipped the employer versus employee. So all it was doing was transferring the right amount of revenue into the health insurance fund. So the health insurance fund wasn't impacted. It was just misclassified within the fund. And it was just one of the retirement portions was flipped 80-20 versus 20-80. So after that was discovered, we went back, made that $8.6 million adjustment, corrected it for this year going forward. All of that has happened from the general ledger accounting perspective. It has zero impact on any deductions that were taken out of employees. And so it would have zero tax implication for any employee.
So it was limited. So in other words, it was limited to how we were tracking it and reporting it, not actually how it was being removed or taken from employee or city, depending on which part of it you're talking about.
Correct. All of that came out right. It was solely a matter of just when we rebuilt our template, because we went from having 2 health insurances to 1, and so we rebuilt the whole thing, and it was just a flip in a formula.
Thank you, sir.
You're welcome.
Carl?
Yeah, so I thought I understood it earlier, but the answer you just gave made me a little bit more confused. So Steve, is what you're saying is you grabbed 8.6 million from the employee's withholding account that you should not have grabbed?
No, so it was the amounts that were in the withholding accounts were correct. It was just the city portion and the employee portion drop into the same bucket, but the right amounts were taken from the respective parties, and then they all drop into one bucket. And then we have to then break that back out to get it in the health insurance fund so we can recognize what was employee and what was employer. And so the payroll will appropriately take the 80-20 or whatever the other one is. We'll just stay with 80-20, but it will take the 80-20. It'll drop those into one bucket. So now you have, of those employees, now you have 100% of their coverage premiums dropped into a specific bucket. And so now we have this 100%. We have to then break it back out when we put it into the health insurance fund so we can recognize what was employee versus what was employer. And just the journal entry of taking it out of that bucket and putting it into the health insurance fund, there were 2, it was just flipped formulas.
So was in fiscal 24 then, was too little taken from the town's general fund, the city's
No.
contribution?
I may
No.
be able to shed some light on this, Carl. If the packet that was included in this email, the PDF, if you were to go to page 73 of that PDF.
Is that in part of this?
Jim, can you
Is
open
that
up
part of
the,
your slide
maybe
deck?
share
Can you bring up slide page
financials?
73?
I can share my screen, Jim, if that works.
Sorry, I just realized I'm on mute. Let me just grab the package here. All right, I will reshare momentarily. Did you say 73 of the PDFs though?
Yes, Jim.
Okay. Okay, 73 should be on the screen now.
So if we look at that far right column, that's your internal service fund, and that's kind of what we're talking about here, Carl. You can see that there are employer contributions for 65 million, and then there's the plan member contributions for 16 million. And then in total for contributions, it's 82,036,000, where Jim has his cursor right now. That number did not change. So before and after Steve's entry, that 82 million did not change. It was just the classification between the two buckets up above. So 6.8 million came out of employee, that second line item, and moved up into employer contributions. So it's just an allocation just specifically on this page. Again, the correct amount was taken out from both the city and the employees from a withholding perspective. It was just how it came into this internal service fund that was incorrect by about 6.8 million. So none of the numbers changed in the internal service fund as a result of Steve's entry. It was just a classification between the employee and the employer. Does that help provide some guidance?
It does. I want to make sure I understand this. So from what you're describing, the correct amount was transferred from both the employee's withholding account, and the correct amount was transferred out of the city's general fund, if I understand it. So there was no impact on unreserved fund balance.
That's correct.
Okay, great. Thanks.
Julia?
Yeah, so the refresh my memory, the change in health insurers that went into effect at the beginning of FY 24.
Yes, July 1st, 2023.
Okay, and then the what's the term you use? The template, was that sort of was the 8.6 million, was that cumulative of the monthly amounts for the whole
Yes.
fiscal year, and then it was
So,
found during the current fiscal year?
8.6 is solely FY 24, as that's what this audit is for, which would be about what's that, maybe $650,000 a month being flipped. So it didn't get caught, which is why Zach doing his work, he caught it. We have since made the journal entry doing the correction, which was caught back in I think probably early October. And so we corrected the July, August, September, corrected the template going forward, and have made sure that that template is working appropriately.
Okay.
And everything's in order right now.
Okay, yeah, I was wondering if it was, so it was basically 12 different monthly transactions that's been fixed, corrected, and then FY 25 has already been corrected for the months that it was going wrong. And so
Yes.
it seems like it was all due to the changeover or creating the new template for the switchover. And
yeah, it was one minor error in the template build out that was undetected, and we don't change that template. We're just dropping data in, outputting data, and importing a journal based off of what came out of payroll. So there's not really any reason to think it would go wrong during the year. So we thought we built it out correct, and then just missed it at year end.
okay, well, good on Zach.
Yeah.
Okay, thank you. And also let's see, the depreciation errors related to the Excel spreadsheet. So you're recommending a change for how we do that out of Excel into some type of program?
Yes, there are certainly programs out there available to the city that they could utilize a software package that would automate the calculation of depreciation and really help streamline this process. It would probably be a little bit of a leg lift in year one to get the information from the Excel file into the software, but after that, it would really help streamline the process.
Okay, the hearing Excel spreadsheet, it kind of reminds me of the election where a couple of precincts had 0 votes in the Excel spreadsheet that got certified initially. So yeah, Excel seems to have potential for human error. Okay, thank you.
And if you want, I can comment a little bit on that.
Hmm.
So we've already reached out to a few communities. There seems to be a relatively good, I've been told it's a bit antiquated, but it does the job. And I spoke with Jim recently, and he said that's what he sees a lot of communities use. It's called Depreciation Works. It's really cheap. We actually looked into Munis's depreciation tool over the last couple of years, and their price is between 80 and 100,000, which is just completely not reasonable for what we use this depreciation for. The Depreciation Works is only a few $100s a year. So the current Excel right now has, I don't know, probably estimating between all tabs, probably over 3,000 lines, and the data goes back 20 plus years. And so every year we're bringing the formulas and the depreciation calculation and everything forward for all of those lines. And it does bring in room for error on these bookings, and we saw that this year.
Okay, thank you.
You're welcome.
Just to I want to just close the loop. I believe there was a question earlier about implications. John Oliver might have asked that. As far as the implications is common, and I'll touch on a point that Alex actually brought up earlier regarding the reporting here on the management letter versus GAO finding. Capital assets, to that opinion unit on the governmental activities, these errors were not material. It was just there was enough there to where we had to make the communication to management to have that corrected, because there were just some things, while not large dollar amounts, they weren't making sense as far as their transition to the footnote. As far as the health insurance fund, the 8.6 million, where we look at it in terms of it's a classification issue, not an impact on the total net position of the health insurance fund or general fund or anything like that. It is just an adjustment to allocation. The 8.6 million did not reach audit materiality, so we're comfortable reporting in the management letter. It was just a matter of, while not material, it was above a threshold where we couldn't completely pass on it. We did have to bring it to management's attention and communicate it so they could correct it. So not material. We do have to call it out in some manner, though, because it's above a threshold where we couldn't just pass on it completely. So
No,
again,
it is an attention getting number, that's for sure.
Yes. Yes.
And the way I think a few of us might have read it, I won't speak for anybody else. I was like, oh, well,
right.
Oops, okay. But then, hearing about it, I get your point, and I would agree. It's too big a number not to go, hey, we should fix this. But it doesn't seem to have any. I think the term you're using, material impact makes sense.
Right.
And from I just have to quick note, like Julia, I gotta go. Sorry. I'm up against a hard deadline here. I got to get something out the door. So thank you all, and happy holidays.
Thank you.
Bye, John. Jim, it maybe something that we can take offline is reevaluate how that comment is being phrased in the letter currently. If it's deceiving in people are thinking it's something that it's not, maybe then we need to reevaluate how it's written so that we can provide some more clarity to the readers of that letter. Okay, moving on to the next comment is the Newton Community Education Program, which is a new comment this year. This was another special project that the city had us go in and do. To maybe provide some context, the Newton Community Education Program has lost money over the past few years, and it was, I believe, in a deficit in fiscal year 25. So I went there, met with those folks, and from an internal control perspective, their internal controls are operating effectively, and they're doing the proper reconciliations, and there's proper segregations of duties. But the issue is with their budgeting process. When they're budgeting to determine the price to charge to the members of the community, as well as to determine what the appropriate class size should be, they're not factoring in all the costs associated with the Newton Community Education Program. So costs such as the management salaries, rent, and then indirect costs such as the pension and OPEB assessments aren't being factored into their budgeting process. And in our opinion, that's the primary reason that, or one of the reasons that they have lost money. And they should be changing that budgetary process to, you know, review those, you know, adjust pricing if necessary. We'd also recommend that the indirect cost allocation be reevaluated to ensure that it's correct. And then again, conduct some periodic reviews of the financial performance, and then reevaluate the class size requirements to make sure that they're appropriate. We can move on, Jim, to the next item.
Can I just, I'm sorry, I didn't find my icon to raise my hand. If I could ask just a couple of questions on this.
Sure.
So Zach, can you just remind me, what type of fund is that program recorded under?
It's a revolving fund, Carl. So it should
And so
be
when you say it's
self-sustaining.
lost money, so does that mean that they had balances from prior years?
Yeah, so they did have some balances from prior years carried over into you know, fiscal 23, fiscal 24. And those balances have steadily decreased year over year.
Okay, and this is a school department program, right? It's under the schools?
That's correct.
And I don't know if anyone can answer this question, is the policy that this be completely self-supporting program? Is that the policies of the school committee?
All revolving funds should be self-sustaining.
Well, they don't have to be. My question is more, is that the policy? It could be subsidized by the
Right.
city, but that's not the policy. Is that what I'm hearing?
No, the only two that are subsidized are North and South Athletics, I believe, and then they budget about $10,000 in case they need to kick in some money for the school lunch bad debt, which nowadays school lunch is fully funded. So that hasn't been an issue in recent years. But otherwise, all programs are expected to be self-sufficient. The Newton Community Ed has been a very hot topic in the school and school committee meetings over the last probably 3 months.
Yeah.
And I'll just let you know that. So the most recent meeting, which I believe may have been December 6th-ish, I had recommended to Liam, and he brought it to the school committee to tie up $500,000 in general fund school budget. So if they cannot remedy this, the school will have to come up with the money to cover the deficit at year end. And so they have tied up $500,000 in school general fund costs or school general fund budget into an encumbrance in case this can't be resolved. They're taking measures and they're doing review, and they anticipate taking more measures, and they'll be monitoring this extremely closely over the next several months. No one expects 500,000 will be needed. It may be 100,000 or 200,000. They're trying to look into that. I believe there's also, and I could be wrong, changes in staffing that are on the horizon for that. So they are doing a very significant deep review of that.
Good, Steve. That's good to hear. And Steve, just one other question. Who prepared the indirect cost analysis?
That I'm not sure. That is, this program is completely handled over in the schools and should be run by the schools. We give them the pension contribution that they need to annually contribute. That's based off the actuarial valuation. And then like we can see the management salaries and the health benefits tied to it, but they do that analysis over on the school side.
Okay, great, thanks.
Julia?
Yeah, yeah, this is a really timely topic, and it prompted me to do what I'd been wanting to do for a while and listen to that. I listened to the 11-4 and 11-18 school committee meetings where this was a topic, and I didn't realize it was a December one. I'll have to check that out. But yeah, basically from what they were saying at the school committee, Newton Community Ed was set up to be an enterprise fund, self-sustaining, And for a long time, they were making enough money for courses that they had surpluses. And then COVID hit and the teachers strike, and that depleted their reserves to the point where they were in a negative balance position. And and they also had a lot of turnover in their director position. And there is the current director has a turnaround plan, which was discussed at the last, at least the 18th school committee meeting, and including things like they've, I think, already implemented a modest increase in the course fees. They cut their course offerings from, I guess it had been Monday through Thursday, and now it's just Monday through Wednesday. So there's less, building charges. And they've already reduced some staff, and I think more staff reduction. 1 point something person is coming, and they changed a couple of full-time positions to 10-month positions. So they've got a plan they're working on, and I believe they're going to be reporting monthly to the school committee and have a full kind of plan as part of the budget process. And I'm going to learn more about it from Kate Carpenter-Bernier in the after the holidays. I did have a question about the allocation of the pension and OPEB assessments. So as I understand it, the staffing for Newton Community Ed, it's a combination of some of the people are, I guess, employees of that program. Some people are, they're paying instructors, some of whom might also be teachers. And is any of the calculation for the pension and OPEB assessment, is that a portion allocated for the people who are already part of the regular school teachers positions? Is if they are also doing classes, is there an attempt to allocate a portion of their pension charge to the NCE?
So if they are a teacher, they would be members of the MTRS, which would not be part of this pension contribution.
Yeah, right. So I guess it would just be the OPEB part, right?
There's
Yeah.
about I want to say 7 FTEs that are under this program. So any benefit employee that's under this program, not a teacher that may step in and teach a class. Any benefit employee in there, they would be responsible. So they would be contributing themselves, the 9+2% contribution to the pension, and then the city as a whole, which would be this program in this case, because this program's employees would be responsible for contributing pension costs as well.
And another thing they mentioned was that I think they were working with the treasurer to see if they could switch to a better, a lower percent of credit card fees on the class payments. Has that happened yet?
I don't know that it happened. I know the conversation has happened because they were concerned about, I want to say it's over $40,000 a month off the top of my head in banking fees that they're responsible for. So yeah, they were looking into that. I don't think that change has happened yet, but I'm not 100% sure. And I do, while I'm speaking, I do want to mention that I misspoke. There wasn't a December 6th meeting. That's actually when I got the memo from the schools. It was based off of the November 18th meeting, which you did.
Right. Okay. All right. Yeah. Yeah. And I hadn't really understood the encumbrance, 500,000, how that amount was arrived at, but apparently it was to cover a worst case scenario.
Yes.
Yeah. Okay. Thank you.
You're welcome.
Carl?
Yeah, so I understand how you can calculate their liability for the pension cost, because we have a normal cost percentage. But how would it be done for OPEB? There's not a normal cost percentage for OPEB.
Steve, you're on mute.
Sorry. So OPEB is, and I can never remember the exact formula that it was if you're hired after maybe somewhere in the 2012, 2015 range. There's a certain percentage that the city, or in this case, the fund would contribute. And so it's a small amount for the OPEB, but it is an amount. It's like 3 point something percent of the salary that the fund would be covering. So I can find the figure to give you a scope of what that amount would have been last year, but it's relatively small, but again, it's something that they're not factoring in when they're doing this.
Sure, yeah, and I guess I was more just curious how you come up with that percentage, whatever it is.
It's something that the administration has set forward in trying to. They had a starting point, and it was any new employees after that year, and then they're slowly increasing the percentage each year to chip away at the OPEB liability as we work on the pension, and then when the pension gets fully funded, they're reevaluating the OPEB thing. But it's a small portion.
Okay. Thanks.
You're welcome.
Jim, do you want to move on to the next comment? Thanks. So the next comment and recommendation is a repeat from the prior year. It's the general ledger integration of police details. So currently the system is not integrated with the city's general ledger. So what we're recommending is that the city continue the process of Munis general billings and then move forward the integration with police details when appropriate. And then the last recommendation that we have is not really a recommendation. Oh, Julia, go ahead.
Yeah, can we go back to police details?
Sure.
Okay, so I know this goes back to at least FY 2020 when it was mentioned. FY 2021, city is currently in the process of piloting Munis general billing with smaller departments. If this pilot is successful, we'll move on to the larger departments, including police details. And then last year, FY 2023, at that point, the management response was the police department is currently working with Delphi, a local software company, in building out a third-party program to handle police details. They have been successful in other local communities that use Munis, such as Walpole and Norwood. The program will be able to integrate with Munis to create, upload files to get everything integrated into both the payroll system and the general billing system soon after. The police department expects this integration to happen within the next month or so. This was in your January letter, and to be fully integrated before the end of the fiscal year. That would have been FY 23. This process will increase accuracies across the board as well as building efficiencies throughout the police detail process. So if it was supposed to happen over a year ago, why hasn't it happened?
I personally do not have a great answer to that. I know this was kind of a joint effort between police IT, I believe his last name is Taccio. I can't think of his first name. The city's IT, Ron, our treasurer, but he's not really involved much in it because he does have a lot of miscellaneous general billing set up in Munis, and all of that's working appropriately. So he has said that Munis is set up and ready to go when they're ready to go. I know that they were having some issues. I don't know why it has taken probably 8 months since they expected to go live, but that is something that we'll be working with the police department on when we generate the management response to that for a good explanation on exactly what's going on over there. Okay,
so in the previous years, it seemed like you're doing small departments first to Munis and then going to get us the bigger departments. Is there anyone else who's not on Munis?
Not that I can think of. There's probably some smaller stuff on the school side that's not, because all of these general billings or miscellaneous bills that are generated through Munis are done through the city's treasury department currently. So this would be something where the police department would be generating these themselves. and I don't know of the schools generating any, but I wouldn't expect the schools to have many.
Mhm.
This is something, so there's certain fines that may be entered into here. So if a regular bill can go out. There's some trash carts, recycling carts.
So
That's sort
basically, the big stuff is done and there's no queue that you're waiting, trying to get done before you do the police.
right. Yeah. The first one that was the real big challenging one was actually the health cash pays for retirees that cut a check to the city for their portion of retirement. Whether that's because their pension check isn't big enough to pay that benefit, or they're choosing cash pay over taking it out of their pension. That was all done manually through HR before. And now it's since been built out with different tables in there for different amounts based on what the retirees percentage is, whether it was the 80-20 or the 70-30. And that's generating those bills, and they're coming in, and that's been successful. And that was the most complex one of any of these programs.
Okay, so at some point I would like to understand Munis better and how it actually works. But basically, so it sounds like the benefit, as stated last year, was to increase accuracies. What is, can you explain the kind of the practical consequence of not having police details rolled into Munis already? Like, who's losing money? If somebody's losing money, what's the effect of not having done it yet?
Zach, do you want that, or do you want me?
I'll start off by saying, and then I'll turn it over to you, see that nobody's losing money. There's not like a loss of money aspect here. I believe it's for a ease of integration and utilizing Munis to the best of its abilities. But Steve, am I correct in that statement?
Yeah, we've been comfortable. Again, it is one of those Excel and third parties with the it's kind of a hybrid of both. And so, but then when everything is collected, then it ends up in Munis. So you're essentially running one program, police details, in 3 different systems. And I think it's working well. I don't think it's efficient. And the auditors for the last several years have obviously agreed with that analysis, that it is not efficient and that we should bring it all into Munis, where there'll be better tracking and better efficiencies.
So it will save somebody time, it sounds like.
Yes.
Okay, thank you. I look forward to all these management responses.
Okay, the last one is not really anything that the city did wrong or there's an internal control issue. This is more of an FYI. And the FYI is that there's going to be a new Governmental Accounting Standards Board statement, which is GASB, that the city will need to implement for their next audit, for their June 30, 2025 audit. And that's in GASB statement number 101, which is in relation to the city's compensated absences or the sick and vacation accruals. So the liability is recognized for leave time that is more likely than not to be used, paid, or otherwise settled. In estimating, more likely than not, a government should consider relevant factors such as employment policies related to the compensated absences and historical information about the use or payment of compensated absences. So again, this is just more of an FYI that this is coming down the pike. We'd be more than happy to work with Steve in helping the city implement this. But I've got no concerns that the city will be able to implement this for their next audit. And then moving on, that was the last recommendation we have. So then just kind of moving forward, Jim, did you want me to take this or did you want to take this? Or Marie, Julie, you've got a question?
Sorry, it wasn't fast enough. Back to the last slide. So that's something that only has to be done at the end of the fiscal year. It's not an ongoing thing.
Nope, just at the end of the year, and you guys will be certainly fine.
Great. Okay, great. Thanks.
You know, I think one recommendation we could throw out there too, Julia, since the information is available, what the city could do is try to perform the calculation for 2024 to see what it would look like and get the ball rolling as far as that goes, to get that opening balance of the liability. But yes, it's a year-end liability for 2025.
Okay.
Okay. So the next steps here, the project is in our quality control review. We never know what they could come up with, but we don't anticipate any significant changes to the act for a management letter at this point. Should we come into any issues through the quality control review, we'll certainly touch base with Steve. But all things considered, we intend to issue the final act for within the month. As far as the next meeting, to keep things in cadence with historical meetings, we would be looking at April of 2025, at which point your federal single audit is going to be due to be filed with the clearinghouse on March 31st. So we feel that April would provide a good debrief as far as providing the committee with the results of the overall compliance audit with the major programs that we have to audit. So want to talk about as far as lining up a date where we could next meet in April 2025 to present the results of that audit, and also talk about what the fiscal 2025 audit looks like. So April 2025 is the general guideline. I don't know if we want to iron out a specific week or a date at this point, but we'll open it up to the committee.
I wish David Mickley were here because there was, I think, a certain day of the week that was worse for him, and I don't remember what it was. Are we on our normal date
Julia,
now?
I can probably represent David on that because it's probably around Passover.
Oh, okay. Are we normally Wednesdays or normally Tuesdays? Did we do a switch somewhere? And are we back to our normal day?
We've historically been Wednesdays, is my experience.
All right, so are we looking at something like, so is April 2nd too early, April 9th? When is, let's see, when is Passover?
Passover starts April 12th, I think. Yeah.
Yeah.
Well, okay, so does the 9th sound okay?
That would be good.
The 9th works for me.
Works for me as well. And just from a timing post meeting, when all of this at April's meeting, when all of this has gone through, then this committee would recommend it to be accepted by city council. And so that would be, a few week turnover after that between going to council, recommended out to finance. Jim and possibly Zach usually would come on and speak to finance, and then it would formally get accepted by the city council. So,
okay.
Just as a kind of what's next for the people in this committee that are new.
Yeah, Steve, what would be a good date for finance to?
Honestly, it's not time sensitive in finance.
Did we do it after the budget this year?
I think we did it during some of the budget meetings.
Okay.
From the individual department level budget meetings.
Okay, I guess we can look that up.
I
Okay.
think we did it right and mixed with those.
Okay.
And at what point, I guess everybody should be thinking of suggestions or ideas for special projects for next year's audit.
I think that would be a fair discussion.
Or this year's audit, basically FY25 that you'll be doing next year.
Right. Okay. With that, I believe that would conclude the presentation here. So would open it up for any additional questions or anything else the committee would like to ask CLA. Okay.
Everybody all set? Okay. Thank you all very much.
Thank you, everybody. Have a good day.
All
Thank you,
right.
everybody.
Thank you.
Good holidays too. Okay. Thank you very much.